welcome back to my channel. So today's video is all about how to trade stocks within the financial sector. So I'll focus on four main companies: Chase, Visa, American Express, and Goldman Sachs. So let's go ahead and dive right into it. So you see I have JPMorgan pulled up here on the option chain, and I'll tell you why in just a second. So first things first, one main thing to know is that trading within the financial sector, it tends to display high systemic correlation during macroeconomic shifts. So you'll hear me talk about that quite a bit in this video, but you will see divergences under company-specific catalysts. So let's break this down using the four tickers that I mentioned. Now, all four of these companies are all heavyweights within the financial sector, but each play a different role in the financial ecosystem. So it's important to break down their behavior in the context of options trading and sector dynamics. Now, I'm going to cover quite a few things in this video as far as financials, but I do want to mention before we get too deep into it that this sector reacts sensitively to interest rates, also yield curve steepness, credit spreads, and liquidity cycles. And again, I'll go into more detail about this in just a second, but the implied volatility structure, options flow, and delta exposure, it can differ wildly across sub-industries, even within finance. So that's the main point of focus in this video. Now, I am looking at the option premiums for May 16th, which will be 17 days of DTE. So I want to go ahead and discuss options liquidity, the volatility, key moves, and then the correlation factor for all of these stocks. Now, when it comes to liquidity, the strong open interest that you see here across multiple strike prices and expirations is ideal for executing multi-leg strategies with tighter bid-ask spreads. And you can see here, even with 3 weeks out of expiration, that there's a good amount of open interest on the call side and even also here on the put side. Now, in reference to the volatility profile, you'll notice that lower IV is relative to Goldman Sachs due to a more diversified revenue stream over time. So typically that's what you'll see. Now, I'll talk more about Goldman Sachs in just a second as well. But in reference to JPM, implied volatility rank, which is the IVR, it tends to sit mid-range unless a macroeconomic report hits or some sort of major catalyst in the news. Now, the key moves when playing JPM is to focus on support holds around dividend dates or earning cycles because the institutional positioning is relatively stable. Now, all four of the stocks that I'm going to discuss in this video reported earnings this month, so these numbers are very recent. Now, one of the main factors to consider is that JPMorgan is highly correlated with broader bank ETFs like XLF, for example, often serving as a sector proxy. So if you're brand new to options trading and you're looking at these bid and these ask prices and you're like, you know what, this is a little too much to pay up front, you can actually trade XLF, and I'll show y'all what that looks like. This is going to be a financial sector ETF. And just as an honorable mention, you can see here that the numbers are going to be way more affordable as far as contract pricing. So even in the money is at $140 for this specific premium, $98, $154. So it's in that range of that $140, $150 range. So it's pretty fairly affordable if you want to go ahead and stick to something within the same kind of industry, but of course have the security of it being an ETF. All right, so moving on to Visa, I'm going to go ahead and put that in here as well. So Visa does have a little bit of a nuance to this specific stock. So despite being a financial company, Visa behaves to me more like a tech adjacent company. And the reason I say that is literally because it's attributed to the fact that they are one of the leading payment processors with defensive beta. So the IV tends to compress faster post earnings, making IV crush plays. Like pre-earnings calls, for example, those spreads or those calendars, they're highly effective if you know exactly what you're doing when you trade them at the right time. Now, in addition to that, the delta behavior, the contracts respond slower to financial news versus JPMorgan or Goldman Sachs. And just as a side note, you'll see the price of the delta ramps up near breakout levels due to slower average true range, which is the ATR. So when you see that, it won't be brand new to you. You'll be able to recognize that and understand that that's typical of Visa. Now, one strategic differentiator is that you can, from time to time, I will say it does work, you can trade this stock in diagonal call spreads, especially during low volatility. And in my opinion, I feel that Visa is a strong candidate for theta positive trades given its mean reverting nature. But I will say in reference to the correlations, it's less correlated to interest rate expectations because this stock is more influenced by consumer spend metrics across broader transactional volume and macro demand. So that's what separates it from the other stocks. So you may be asking yourself like, wait, what does that even mean? So all I'm really saying is that the stock's price movement doesn't strongly track interest rate shifts, but reacts more to how much consumers are spending and how many transactions, especially international, are happening. So it reflects a business model tied more to global economic activity and consumer behavior than central banking policies. So yeah, that's pretty much Visa. So let's move on to AXP, which is American Express. Now, I can give forewarning that American Express is a credit cycle sensitive stock, but you do have the opportunity to have an options edge because AXP contracts are a hybrid. You get the discretionary credit risk exposure like banks, but with consumer cyclicality built in. So the IV surges more than Visa post earnings, so earnings plays are much more lucrative when it comes to AXP, at least in my opinion. So for anyone wondering how they can play this, what this means is that AXP options offer exposure to both banking-like credit risk and the ups and downs of consumer spending, making them behave like a blend of a lender and a retailer. Now, since implied volatility spikes more for American Express than for Visa after earnings, short-term options trades around earnings tend to offer higher payoff potential. But I will say that Amex does have some flow behavior that you should look out for as well. So it's pros and cons to it. So you want to watch for unusual options activity around Fed rate decisions, and that's directly related to the fact that it's a leading indicator of consumer credit tightening. So one ideal strategy that you could utilize is directional debit spreads or bullish butterflies when playing post-pullback reversals off the 200 EMA support. And the reason I think that's super important is at the correlation range. Now with Amex, there is a higher correlation with JPMorgan and GS during economic inflection points, but diverges during inflation prints due to consumer exposure. So think of it like this. Amex tends to move in sync with JP Morgan and Goldman Sachs when the economy shifts direction, like entering a recession or recovery, because all three react to broad financial trends. However, during key inflation updates, Amex often trades differently since its revenue is more directly tied to consumer spending, which reacts faster to rising prices than institutional banking does. So I hope that makes sense. All right, moving on to GS. Let me go ahead and get that pulled up here. Now, when trading GS, I'm looking at trading revenue and deal flow dependency just to see how it flows. Now, in regard to the option sensitivity, I can say that one of the most IV reactive names in the sector is Goldman Sachs, and GS options tend to carry higher premiums, so ratio spreads are a solid play during periods of elevated VIX, and that's just the volatility index. Now, I also heavily focus on the Greek dynamics when I'm looking at trading GS, because gamma spikes fast during earnings weeks, and if you paid attention to it when they reported it, you saw that actually happening, especially during the lead up to it and the post earnings. Now, if you're short premium, gamma exposure becomes risky, especially when macro data hits alongside earnings. Now, liquidity behavior plays a major role in why this happens because large dark pool prints tend to precede institutional positioning because GS is often used for sector sentiment trades, especially when banks are under pressure because GS options tend to light up first. And this just plays into the fact that institutional investors often trade Goldman Sachs as the go-to stock to express their views on the entire financial sector. So when there's negative sentiment around banks, GS options typically see a surge in volume and volatility before other names, acting as a lead indicator for broader sector moves. So the main takeaway with this is that the correlational difference is that GS tends to lead the sector during financial stress, but it lags during consumer-led rallies. So if you're able to understand this divergence, you can capitalize on pairs trade using similar options. And I have made a video discussing that, but it's simply going to be here under this tab right here that says pairs trader. Now to give a correlation in options, just remember that volatility clustering with JP Morgan and Goldman Sachs, you'll see a spike in IV together during banking regulation rumors or Fed statements. So I'm pretty sure y'all have all heard it before where people will say, buy the rumor, sell the news. That's exactly what you should do for JP Morgan and Goldman Sachs, at least from my historical reference. Now, Amex lags slightly and Visa often stays insulated. So the spread compression is that American Express and Visa options tighten faster post-news, while JP Morgan and Goldman Sachs linger longer due to institutional hedging and delta neutral positioning. Now, a sector dispersion strategy that I can give out is that if JPM's calls are running and GS lags, another tip you can use is to build a long call on Goldman Sachs funded by a short call on JP Morgan. And this is expecting mean reversion. Now, hedging behavior can also play a huge part of this as well because Visa is often used by funds to hedge consumer credit exposure without taking on full financial beta. Now, that's why Visa options don't always follow the same volatility path as JP Morgan or Goldman Sachs. So you'll notice that from time to time. And this just basically means that institutional funds use Visa options to protect against risk in consumer credit trends without overexposing themselves to higher volatility tied to standard institutions. So as a result, Visa options behave differently and show a little less extreme price swings from JP Morgan or Goldman Sachs. And real quick, y'all, before I hop into the beta, I do want to give out one actual advanced strategy suggestion. And this is going to be something you can use for like a sector skew. So if you notice bullish divergence in Visa and American Express, but bearish flow in JPMorgan and Goldman Sachs, there's a couple different things you could do. One, you can set a long call spread on Amex and Visa, or you can side with a short call or long put on Goldman Sachs. Now, this will offset the theta decay by using short-dated spreads on Amex or Visa and longer-dated puts on GS. So just a little free game that I'm giving out. This strategy does thrive in dispersion environments where the correlations break temporarily, so just keep that in mind. Okay, so now that I've offered that explanation on the comparison of them all, let me go ahead and hop into the beta, and we'll do a quick comparison of them all under the MarketWatch. All right, I'm going to type in JPM here. I'm going to have Visa here, AXP, and GS, of course. Now, I have made a dedicated video discussing this MarketWatch tab, so I'll leave a link for that down below. So in order to pull up the beta, I'm going to go ahead and click on this little gear icon right here, and I'm going to click Customize. And right here underneath all columns for looking up a column, I'm going to type in the beta, pull that up here, and I'll simply click on OK. And now you can see the number for the beta here on the right. Okay, so starting off with JP Morgan here. So for anyone who's unaware, the beta just measures how much a stock moves compared to the overall market, meaning the S&P 500. So beta tells you how reactive a stock is because it's determining a company's stock volatility relative to the broader market sentiment. Now, high beta stocks are typically at a 1.5 or higher, and this is great for short-term trading and options with fast movers like Tesla, Nvidia, and AMD. Now, low beta stocks are under 1, and this is better for stability for like defensive sectors or capital preservation swings like utilities or consumer staples. Now, a pro tip is if you're swinging with a tight stop and trying to catch momentum, beta helps you spot the intensity of the move. Stocks with higher beta often move enough to make directional plays worth it, but they require tighter risk control. So you have to make sure your risk tolerance is super on point. Now you will notice here that the S&P 500, so SPX and SPY, they have a beta at 1 because again, SPX sets the standard because it is the index. So when we take a look at JP Morgan here, the beta is at a 1.055. And this aligns closely with the market volatility, reflecting its diversified banking operations. Now Visa has a beta of a 0.94. And this exhibits lower volatility than the market, indicating a more stable performance. Hence why I was saying Visa is the more stable stock to choose out of the 4 if you did want to trade and you're maybe like new to trading and you wanted to start small and kind of just make the market work in your favor based upon lower volatility. Visa is a great stock to choose because it does move, but it won't offer as much volatility as the others. Which is good because if you're brand new, trading stocks that are a little more stable do play in your advantage if you're seeking more grounded trades. Now, American Express here, they have a beta of a 1.208, and this shows higher volatility, suggesting greater sensitivity to market movements. And then lastly is Goldman Sachs. They have a beta of a 1.288, which is the highest of them all, and this indicates elevated volatility, often due to its investment banking activities, of course. So again, paying attention to the beta is super important because you can compare this number to the S&P to see if the stock is moving erratic or if it has more stability in contrast. Alright, so the next thing to take a look at is the fundamentals because we can't talk about trading these stocks even within options trading without mentioning the fundamentals. So I'm going to go ahead and click under the Analyze tab here, and we're already under fundamentals. So I'll go ahead and type in JPM to start. And I'll go ahead and scroll down here and we're going to take a look at by the numbers. Now I can say that JP Morgan reported earnings on April 11th of this month. So you will see that reflected not here under annually, but you'll see it reflected here under quarterly. Now they reported their net income at $14.6 billion with an EPS here at $5.07. And this is surpassing the analyst expectations. They also reported that their revenue reach was $45.3 billion, and of course that's driven by strong net interest income and robust trading activity that has taken place. We can also see the profitability as far as the return on equity is at a 16.82. We also see their financial leverage down here as far as assets to equity is 13.15. But I like to take a look at the valuation, but more importantly, the growth rates. Now, when we take a look at these numbers here, we can see that, of course, it's comparing the current rate to the 3-year and the 5-year average. So the current revenue is at a 12.74, which is outperforming the 3-year and the 5-year as we can see. Net income is doing the same as well. It's at a 18.56. The EPS is also up at a 23.06, and they also are outperforming when we look at the dividends per share at 18.82. So based on the numbers here, we see that JP Morgan is all green. So obviously this information is super important and you definitely want to keep it in mind. But let's go ahead and take a look at Visa. Do the same thing. Scroll down just a little bit here. And to start, Visa reported earnings on April 29th, and they posted that their adjusted profit is at $5.4 billion. Now, we don't see the earnings per share listed here, but I can tell you that it is at $2.76 per share, exceeding the analyst forecast. The company also announced a $30 billion share repurchase program, which I personally think is just like them reflecting confidence in sustained consumer spending. Now, because their earnings report is so recent at the time of me filming this video, we see most of this is kind of blacked out as NA, but it won't be for long. But again, this is just literally the day after that they posted the earnings, so of course it may not be updated just yet. But if we go ahead and take a look at the growth rates here, we can see that they're essentially pretty stable, and we can see some growth as well. So currently, we can see that their revenue is at a 10.34. We see their net income is at 11.05. Their earnings per share is at a 14.18. And then the dividends per share is at a 14.43. So not too bad. I mean, the numbers aren't perfect, but again, it's not terrible either. All right, so moving on to AXP, we'll go ahead and pull that back up. Let's scroll down just a little bit. Now, American Express reported earnings on April 17th. Their delivered revenue was $17 billion, which is up 7% year over year, and their EPS is $3.64. Now, in reference to this, the company raised its full year EPS guidance to a range of $15 to $15.50, so that's a benefit. We can also see that the profitability as far as return on equity, at least from Q4 of 2024 to Q1 of 2025, has gone up. So it's currently at a 33.63. However, when we take a look at the growth rates, we do see a little bit of a difference and a little bit of regression. Now, although they are up 7% with their YOY, we can see that their revenue currently is down from the last 3 to 5 years. It's at a 9.05. The net income is a little bit stagnant as well because we can see it at a 14.24. Same thing with their EPS at a 17.97. And then the dividends per share is at a 16.8. So honestly, not the best numbers to look at in the world, but again, it's certainly not the worst. But either way, you can still play this stock to your advantage. All right, last but not least is going to be Goldman Sachs. I'm going to go ahead and pull those numbers up here. Scroll down just a bit. Now, GS reported earnings on April 14th. They reported their net revenue as just a little over $15 billion and their net earnings at $4.74 billion, with an EPS of $14.12. Now, their performance was heightened by strong trading revenues and a rebound in capital markets activity, so if you know, you know. And they're remaining pretty solid when we take a look at the growth rates down here. We can see that the current revenue is at 13.52. We see the net income is at a 58.08. EPS is at a 68.38. And then the dividends per share is down at a 9.3. So for the most part, we do see that there is growth, especially in comparison to the last 3-year average. And that also shows a reflection in their profitability here. As far as that ROE, you can see it at 15.83, but their gross profit margin has remained pretty much relatively stable at an 84.05. So all in all, not bad at all. The numbers are fairly decent. We don't see any major cause for concern. Everything is looking pretty straight for them. And of course, Goldman Sachs is definitely a company that has been around for decades, so nothing crazy. Okay, so the last thing I want to cover in this video is a quick comparison of these companies' metrics as it relates to the implied volatility, the rank, and the open interest. So let's jump into that. Okay, so here's a quick but detailed breakdown of the option metrics for these stocks, focusing on implied volatility, IV rank, and open interest. So moving forward, if you did have an interest in trading these stocks, you can at least set your expectations for them. So starting off with JP Morgan, the implied volatility is currently at 26.3%, placing it in the 82nd percentile over the past year, and this is indicating relatively high market expectations for future volatility. So it's a good idea to keep that in mind. Now the open interest, on the other hand, it is showing strong numbers across multiple strikes and expirations, which provides ample liquidity for various option strategies. Now, as far as strategic insight, the elevated IV and defined OI suggest opportunities for premium selling strategies, especially around future earnings announcements or any type of major macroeconomic events. Now, Visa's implied volatility is at 24.1% currently, with an IV rank of 65%, indicating moderate expectations for price movement. So, of course, it's staying within that range. Now, the open interest is also moderate, primarily concentrated around the at-the-money option, so you'll see that, of course, at least within the specific time frame of me filming this video. Now, given its lower IV and concentrated OI, Visa may be more suitable for directional strategies, particularly when anticipating post-earnings movement. Now, when looking at American Express, the implied volatility is currently at 29.5% with an IV rank of 77%, which reflects heightened expectations for price fluctuations. Now, the open interest is moderate with noticeable increases around earnings periods, so that's always typically what happens. So a good tip to keep in mind for this is that the higher IV suggests potential for strategies that benefit from volatility contraction post-earnings, such as like calendar spreads or even like iron butterflies. And then last but not least is of course Goldman Sachs. Their implied volatility is currently at 32.3%, placing it in the 86th percentile. And all this indicates is that there's a significant market expectation for future volatility. Now, since their open interest is high, especially near term expirations, this offers the flexibility for short-term trades. So it's a good idea to be very strategic with the elevated IV and substantial OI makes GS a candidate for premium selling strategies as well, particularly during periods of anticipated volatility spikes. So for the most part, comparatively, the main takeaway is that within volatility trends, GS exhibits the highest implied volatility among the four, suggesting greater expected price movement, while Visa shows the lowest, indicating more stable expectations. So if you know you're one to kind of trade more stable stocks, you may decide that Visa is a good opportunity to do so. You may want to look into Visa and kind of see if the numbers fit into your trading plan. Now, on the topic of open interest distribution, JPMorgan and Goldman Sachs have higher open interest, providing better liquidity for complex option strategies, whereas Visa and American Express have more concentrated open interest, potentially limiting that type of strategy flexibility. Not saying it's not possible for certain trades, you just have to be a little more strategic when doing so. And now that I'm thinking about it, within those strategic considerations, you may want to consider employing volatility-based strategies on GS and American Express while focusing on directional plays for Visa and JP Morgan. And of course, it's all dependent on market conditions and individual risk tolerance. And that's completely personal preference on how you choose to go about your trading, but I just wanted to make that recommendation. So yeah, y'all, this was all I really wanted to cover in this video. If y'all need a more detailed breakdown on any of these topics, just let me know. So with that, that'll pretty much do it for this video. If you found this information to be helpful, feel free to leave me a comment down below. As always, I thank you so much for watching, and of course, I'll see y'all in my next one.